Friends, mentorship program. Today, first session, we are starting with a quick revision on these topics, dividend policy and cost of capital. Shall we begin with dividend policy now? Friends, foremost concept which is not there in any of the books, but I normally give it in my classes is that how to value any asset. Friends, this concept is very, very important. Value of any asset, friends, whatever asset you're talking about, is actually nothing but it is the present value of the future cash flows which the asset can generate. So again, I will repeat, friends, what is the value of an asset? Value of an asset is nothing but it is the present value of future cash flows that the asset can generate. Why like that? I'll give you a very, very simple example, friends. You all like watching movies. Tell me who's your favorite actor? Who is your favorite actor? Come on, tell me fast. Favorite actor's name? Is it a very tough question? Put the answer in the comment box, quick. Come on. No favorite actor. You all just sit and study the whole day. You don't watch any movies. Not even a single movie. Okay, I will tell you my favorite actor's name, Hrithik Roshan. Have you all seen his movies? Yeah. So Hrithik Roshan, when he's acting in a movie, how much money does he charge for his one movie? Normally, Hrithik Roshan charges a minimum of 10 crore. Why do you think the film industry is willing to pay Hrithik Roshan 10 crore? Then you talk about any other flop actor. Now, for example, off late in Instagram, I'm seeing one particular fellow, one particular lady, Dhinchak Pooja. Have you heard of her? Just whenever you're free, go and search her in Instagram, listen to her songs. You will get heart attack. How much money will Dhinchak Pooja charge if she's acting in a movie? Friends, she will charge 0 rupees. Not only that, she may have to pay money that side to act in the movies. Alright. That is because value of Hrithik Roshan is present value of whatever is the future cash flow that Hrithik Roshan can generate. So basically, if Hrithik Roshan acts in a movie, he has a basic fan following. These fellows will go and watch the movie. Automatically, revenue will come up and the revenue that the movie generates will be easily more than 10 crore. Otherwise, nobody will be willing to pay 10 crore to Hrithik Roshan. But if Dhinchak Pooja acts in a movie, nobody will go to the theater to watch it. So her value will become 0. Just like that, value of any asset is nothing but it is the present value of future cash flows that the asset can generate. Is everybody clear so far? Please give me a thumbs up in the chat box. Come on, quick, one thumbs up. Fantastic. Okay, so keep on interacting with me. Whenever I say just put a thumbs up, so I will come to know that we both are moving in the same platform. Now, next important concept that we need to learn is the logic of perpetuity. What do you mean by the word perpetuity? Friends, perpetuity means infinity. In normal scenario, a business is something which normally goes towards perpetuity because every business has a concept called as going concern. The business will go on forever. So whenever a business is going on forever, we need to find out the value of a business. Now tell me, what will be the value of a business? Value of a business will be nothing but it will be the present value of future cash flows which the business can generate. Everybody clear with this part now? So whatever is the future cash flows that the business generates, the present value of that future cash flow is what is relevant over here. Is everybody clear so far? Yes, please put a thumbs up in the chat box. So now here what will happen is future cash flows goes on forever. So when something goes on forever, that is what we call it as perpetuity. Okay, so to get the present value of perpetuity or to find out the present value of perpetuity, the formula that we use will be cash flow divided by discount factor minus growth. Everyone repeat the formula once again. What is the formula? Cash flow divided by discount factor minus growth. So if the business is able to generate 10 lakh rupees forever. The discounting factor is 10% and there is a growth rate of, let us say, 5%. So what will be 10 divided by 5? Everyone tell me. What is the answer that you get over here? Do you get the answer as 200 lakhs? Is everybody clear with this part now? Okay. So that is the formula for perpetuity. Everyone tell me what's the formula for perpetuity? Cash flow divided by discounting factor minus growth. Is everybody clear so far? If yes, can you please put a thumbs up in the chat box? Perfect. Can I go to the next concept now? So we learned two concepts. Concept number one, value of any asset is nothing but it is the present value of future cash flows which the asset can actually generate. Everybody clear? Point number two, what we are talking about over here is that in case of perpetuity, the formula to be used is what? Cash flow divided by discounting factor minus growth. That is the formula that we use for cash flow. Everybody, perpetuity. Everybody clear? Then we learn the formula for Gordon's model. I think you know the formula for Gordon's model. Okay. Friends, Gordon's model is also nothing but it is a perpetuity formula which I will explain to you now. I told you what is the formula for perpetuity? Present value of perpetuity is equal to cash flow divided by discount factor minus growth. The formula for Gordon's model is P0 is equal to D1 divided by KE minus G. Isn't this formula similar to the perpetuity formula that I just now told you, friends? Or in other words, this is dividend. This is the discounting factor or this is equity holders discount factor. And the growth remains the same. Or what they are trying to tell you over here is that value of an equity share. Value of an equity share is present value of future dividends which the equity share can generate. Friends, in my recorded lectures, I am covering this in much more detail. Right now, it's only a revision part, so I am doing it very, very quickly. Hold on, friends. Is there any video issue? Is my video getting stuck? Am I audible? Is there any disturbance coming in? Please confirm and let me know. Is everything comfortable and clear for all of you, friends? Perfect. All right. Everything is clear, right? So we learned three things, friends. What is the first thing we learned? Value of an asset is nothing but present value of future cash flows. What is the second thing that we learned? In case of perpetuity, the formula is cash flow divided by discount factor minus growth. Gordon's model is also nothing but cash flow divided by discounting factor minus growth is what is coming for Gordon's model also. Okay. The next model that we need to learn over here is called as the Walters model. Walters model, the formula is D divided by KE plus E minus D into R by KE whole divided by KE. Earlier, I taught you that in Gordon's model, the value of a share is nothing but present value of future cash flows. There, the formula was D1 divided by KE minus G. Here, if you observe, they have only taken D1 by KE. So, basically, what have they done? They have removed the growth from here. So, can I say this is nothing but this is the present value of dividends without considering the growth? Yes or no? Whereas this one, E minus D into R by K, E minus D is nothing but retained money. This retained money is getting reinvested. Okay. So this is present value of retained earnings, which is reinvested. So friends, basically these two are together nothing but they are present value of future cash flows only. So friends, let it be Gordon or let it be Walter, all are telling the same thing. What is the same thing they are telling? Value of a share is nothing but it is the present value of future cash flows that the asset can generate. Is everybody clear with this part? Please type a thumbs up in the chat box. Fantastic. So we are clear with Walter's model also. Shall I go to the next one now? Alright, let me go to the next one. Next one that you have to learn is called as Modigliani-Miller. Okay. Modigliani-Miller, the formula is NP0 is equal to P1 into N plus M plus E minus I whole divided by 1 plus KE. Let us decode this formula. N means number of shares. P0 means price today. So NP0 will be nothing but it will be the total market value today. Yes or no? That is equal to P1 is price next year. N is number of shares. M is new number of shares. So what will be N plus M, my dear friends? That will be total shares afterwards. Total shares into P1 will give you total market value after 1 year. Am I right? So this is nothing but total market value after 1 year. This along with earnings minus investment will be nothing but it will be the cash flow next year. Yes or no? Now when you divide it by 1 plus KE, basically divide by 1 plus KE is nothing but the present value factor. Friends, for 10% the PV factor is 0.909. How do you get this 909? 1 divided by 1 plus 10 percentage or 1 divided by 1 plus KE. So basically what does this formula say? It again say it is the present value of future cash flows, or total market value today is nothing but it is the present value of future cash flows that the business can generate. This is exactly the same thing that Gordon also told. This is exactly the same thing that Walter said. This is exactly the same thing that Modigliani-Miller is also saying. Are you clear with this concept, friends? Put a thumbs up in the chat box. Friends, all these detailed derivation and the concept is explained in my classes. Here I am telling it very quickly and precisely. Okay, can I go to the next part now? So we have learnt about Gordon, we have learnt about Walter, we have also learnt about Modigliani-Miller. Everybody clear with these three parts? Now let me go to the next one. The next important concept that we need to learn is called as the two-stage dividend discount model. I will explain this with the help of an example, friends. Alright. So let us say D1 is turning out to be 10 rupees. D2 is 20 rupees. D3 turns out to be 30 rupees. After this, they say from D4 onwards, it will grow at the rate of 5% towards perpetuity. So what are they saying, friends? First year you get 10 rupee. Second year you get 20 rupee. Third year you get 30 rupee. Then from fourth year onwards, it goes on forever towards perpetuity. Everybody clear with this part? And let us say their cost of equity is turning out to be 20%. They are asking you to find out the value of the share. Friends, we have learned one thing. Value of a share is nothing but it is the present value of the future cash flows that the company can generate. Here the problem is you have these three cash flows. Along with this, you are having a perpetual cash flow also. Yes or no? So in that case, we will do it in two steps. Step number one, we will find out the present value of high growth cash flow. Here I'll put a table here. Cash flow, discount factor, discounted cash flow. Year 1 10, year 2 20, year 3 30. What is your discounting factor? 20%. So it will be 0.833, 0.694. Next one will be what? 0.578. Am I right? So your DCF will turn out to be 8.35, 13.88, 11.554. Now what happens is the second step will be over here. Step number 2, present value of perpetual cash flow. So friends, we have learned the formula P0 is equal to D1 divided by KE minus G. If that is the case, here I have D4 divided by KE minus G. Tell me, my dear friends, D4 divided by KE minus G will give you price at the end of which year, friends? It will give you price at the end of third year. How much is D4 now? 30 plus 5% divided by 20% minus 15%. Sorry, 20% minus 5%. Sorry, it is 20% minus 5%. So do I get the answer over here as 210? This 210 is price at the end of the third year. So at the end of the third year, I will bring this 210 and again take a present value at 0.578. So I'll get the number over here as how much? 121.38. Once I put this, what will be my total number that I get over here, friends? 56 plus 121.38. Do I get the answer as 155.17? Is everybody clear with this part now? Fantastic. So that is how we will go and find out the value using two-stage dividend discount model. Two steps are there. Step number 1, present value of high growth cash flow. Step number 2, present value of perpetual cash flow. Is everybody clear with this part? If yes, please put a thumbs up in the chat box, friends. These were the important topics in which chapter, friends? Dividend policy. Now we go to the next one, that is called as cost of capital. Overview in this chapter, we need to learn what is KE, we need to learn what is KP, and we need to learn what is KD. So to learn KE, this is normally done either using Gordon's model or this is done using CAPM formula. What is the formula for Gordon's model? Everyone tell me. P0 is equal to D1 divided by KE minus G. So if I turn around the formula, can I indirectly say KE is equal to D1 divided by P0 plus G? Is everybody clear with this part? Okay, so this is one of the formula to calculate what? KE. The second formula, and which is a more powerful formula, is the CAPM formula, because CAPM formula got the Nobel Prize, friends. The formula under CAPM is RF plus beta into RM minus RF. Everyone repeat the formula. RF plus beta into RM minus RF. Is everybody clear with this part now? Fantastic. Okay, then now we need to learn about KP and then we will learn about KD. So when I learn about KP, there are two types of preference share. KP is the cost of preference share. One is what we call it as redeemable preference share, and the other one is what we call it as irredeemable preference share. Irredeemable preference share means they will never be redeemed. So that means it will go on forever. If they are going on forever, what do we call them, friends? We will call them as perpetual shares. Now tell me, what is the formula for perpetuity? Cash flow divided by discounting factor minus growth. In case of preference shares, what is the cash flow? In case of preference shares, the cash flow is the preference dividend divided by what is the discounting factor that we normally use for this thing? It is called as KP minus G. In normally, friends, in case of preference share, you don't have a growth. So ideally growth is not there, but still I'll keep G if required. This will be your P0. Yes or no? So price is nothing but preference dividend divided by KP minus G. Now if I turn it around, what will be the formula? KP is equal to your preference dividend divided by P0 plus G. Friends, normally G will not come. So even if you ignore G, this will be the formula, because preference dividend normally does not grow unless the preferential term says that every year I'll give you 10% growth rate. 99% chance preference dividend will not have a growth rate. So ideally, what is the formula for preference dividend in case of irredeemable preference dividend? KP is equal to preference dividend divided by P0. Is everybody clear with this part? Please give me a thumbs up in the chat box. Fantastic. Keep on interacting. Okay, that's the only way I can be sure that you're understanding what is happening. It will take you 1 minute to put a thumbs up, but then also your brain will refocus. Now, when you're going for redeemable preference share, there is a method that they use. This method is called as approximation method. Okay. As per this method, the formula goes like this. The formula would be preference dividend, whatever is the dividend, plus redemption value minus issue price divided by life, whole divided by redemption value plus issue price divided by 2. Okay. So I will just show you this with the help of some numbers. Let us say the preference dividend is 10 rupees plus your redemption value is turning out to be 120. Issue price is 90. Life is 5 years. Whole divided by 120 plus 90 divided by 2. So what is this? 30 divided by 5 plus 10, 16. 16 divided by 105. So now tell me, what is 16 divided by 105? Do you get the answer as 15.23%? I'll tell you the logic of this formula now. As an investor, so if I am an investor, the logic I'm telling you now, okay? There are two things. One, I invest some money. Two, I get some returns over here. Correct? I repeat once again. As an investor, I invest some money. And what is the second thing that I do over there? I get some returns back. So now, when I'm investing some money over here, what is going to happen over here is that I am investing initially opening investment of minus 120. What is my closing investment? 90. Therefore, what is going to be my average investment over here? Does my average investment turn out to be 105? What about the returns? I am going to get preference dividend every year. How much is my preference dividend every year? 10 rupees. Apart from this, I will get capital gains also. So I am selling it for 120, whereas I am buying it for 90. What is 120 minus 90? Everyone tell me. 30. 30 is my total return over 5 years. Yes or no? If 30 is my total return over 5 years, what will be my return in 1 year? 30 divided by 6. Sorry, 30 divided by 5. That is 6. Am I right? So now tell me, what is my yearly returns that I get over here? 16 rupees. So as an investor who has invested 105, he is getting 16 rupees. So what is the return on investment that he is getting in his hands? He is getting an ROI of 15.23. This is called as KP. Are you all clear with this part now, friends? Please put a thumbs up in the chat box if you have understood this. I'll give you 1 minute cool off time to read this and understand this part. Okay. This was little tricky. Too much of numbers were there. Alright. So I think we are clear with KP also. There are two types of preference shares. Redeemable, irredeemable. Irredeemable is perpetual. So there the formula will be the perpetuity formula. KP is equal to preference dividend divided by P0. Redeemable, it will be preference dividend plus RV minus IP divided by life whole divided by RV plus IP divided by 2. Is everybody clear with this part now? I will now go to the last part, that is KD. KD is exactly similar to KP. Only difference is that when you have an interest, you have a 1 minus tax rate. So there are two types of KD also, debt also. Redeemable debt is there. Irredeemable debt is there. Irredeemable debt, the formula will be KD is equal to interest into 1 minus tax divided by P0. KP, what was the formula? Preference dividend divided by P0 because there's no tax impact coming on that. But here it will be interest into 1 minus tax divided by P0. Everybody clear? When you go for redeemable, same formula. There it was dividend, here it will be interest into 1 minus tax plus redemption value minus issue price divided by life whole divided by RV plus IP divided by 2. Are you all clear with this part? If yes, please put a thumbs up again in the chat box, friends. Super, fantastic. Okay, everybody clear with this part, right? I will go to the next one now. Last one to be learned over here is what? WACC. WACC is nothing but the weighted average. KE into weight of equity plus KD into weight of debt plus KP into weight of preference all together is what you get your weighted average cost of capital. For this, your weights can either be taken based on book value or the weights can be taken based on market value. Which is actually better, friends? Book value is better or market value is better? Always market value is better, but sometimes in your exam, if they are asking, you can do it using book value also. Everybody clear with this part also? Yes. Last but not the least, you have something called as marginal WACC. What do you mean by the word marginal? Marginal means additional, extra. Everybody clear? So marginal WACC means when you're raising some extra funds, the formula will be additional KE into weight of equity plus additional KD into weight of debt plus additional KP into weight of preference share. That's it, friends. Concept revision is over with this. Has everybody understood the concepts, the important concepts? Now I will leave the desk open. If you have any doubts before that, friends, I have shared 2 books with all of you. Did you get those 2 books? It has taken a lot of time for me to prepare that, friends. Please do value that material. And that material has helped a lot of students get an exemption in Inter FM. So I'll just show you. The most important book is the ODBE book. One moment. Not here. CA Inter books. ODB book is very crucial, friends, because if you look at this book, this contains so far very less questions. Now, Rambo 1 question is there. Then if you come down, you have 2, 3, hardly 6 or 7 questions. But the moment you do this 5, 6 or 7 questions, you cover the entire dividend chapter. Are you getting my point? Same is the case with cost of capital also. Now, if you want to do a more elaborate revision, I also have prepared a mastery book. Mastery book is a much bigger book. Okay, I did not change the index cover. I just kept it like that because I'm giving it free of cost right now. So here the chapter wise, if you go and check, you have the basics, present value, full logic is written and explained the way I take my classes, friends. Are you clear? So these 2 materials are given to all of you free of cost. Please utilize the material. Now I will change my settings so that we can have a live interaction and we can pack up today's class. Okay, right. So friends, I hope you all can see me now. Now you can unmute, ask me your doubts. How is your studies going on? Are you facing any difficulty? Any extra support you need from my side? Whatever required, tell me. I am here to clarify all that for you. Yes, Aishwarya, Benjamin, Arya, is everything sorted and clear? Rajgopal, which point you want me to repeat? Sorry, Rajgopal, I missed out your message. Just let me know. I will repeat once again. No issues at all. Just tell me. Rajgopal, which part you want me to repeat? Can you please explain once again? You can unmute and speak to me. I believe you can unmute. Am I right? All right. I think Rajgopal.
Can you hear me? Myself, Aksheshwara.
Hi, Achaleshwara. I can hear you. Yes, Achaleshwara. Please tell me.
Yeah. Okay, sir. As of now, I don't have any doubts yet because I haven't started my
Okay. I will explain to you. I'll explain to you. So now, for example, you have enrolled for the pre-mentorship, right? So what we will do is now you have, let us say, for example, you have prepared for the last 1 week on dividend policy, cost of capital. What is the objective of learning this? That tomorrow if I ask you a question, you should be able to answer that, right? So we will give you a small question paper, maybe 5 or 10 questions from that chapter. Okay, that question paper will be your assignment. After you do that, we'll be giving you an answer key. So you can evaluate where you are standing. Are you getting my point? Later on, we have also kept a premium test series that is happening in the month of April. There, we will have full-fledged 100 mark question paper that will be evaluated by a chartered accountant. Are you getting my point? This assignment is free. So you will have 10 questions which you solve it yourself. Then we'll give you the answer sheet. Then you have to evaluate and tell me how much you scored in those 10 questions. How many questions you have got it right. So it is basically like a small mini examination to test whether you have studied it properly. Is that clear to you, Achaleshwara?
Yes, sir. Thank you. When does these assignments due, sir? Have you already?
What I have told my team is I have asked my team to create a broadcast with each and every one of you. Okay. So you will be getting personal WhatsApp message from my team. Are you getting that message?
No, sir.
Have you enrolled for the mentorship?
Yes,
Okay. Are you also there in the WhatsApp group, that FM group that we have created? Are you there in the group also? Then I'll do one thing. I don't know, messages are going, but out of, I think some students, WhatsApp, due to some security reasons, when I'm sending bulk messages, it is not reaching some students. What I will do is send me a message that you did not get any message from my helpline number. This is my WhatsApp mobile number. Send me that, I'll forward it to my helpline team. They will check this and they will get back to you. Okay.
yes, sir.
And I will ask her to put the same message in the Inter FM WhatsApp group also, so that by chance if somebody is missing out on the personal message part, ideally the personal messaging would help much more. But I'm not sure why it is not getting delivered to you, because I have put my number also as a test number. I am getting the message. So others also, friends, when you get a message, please give a reply. I'm not sure how this WhatsApp algorithm works. Maybe since you're sending messages to 10, 20, 30 people at a shot, maybe some messages are getting missed out. Maybe that is the reason.
Sir, will it be possible for us to work out a WA because in dividend all
Okay, what we will do is now 9:30 the next session will start. We have only 10 minutes left. If possible, I will do it. I will just open the material. Just give me a moment. We'll take a question. But it would be much better, actually, sir, if you just work. Next week, I'm going live every week, right? So now in my ODB book, I'll give you a WACC. You want a WACC question, right? I'll tell you which question. Just do that yourself. And then in the next class, when you ask me a doubt, it will be easier for me to clarify that for you rather than solving the whole problem in the doubt clearing session. Now, for example, take this question, just note it down. Question number 17. Question number 17, it is coming on page number, I think, 26 in the PDF.
okay, sir. Like I will within next week I'll try to cover these two topics.
Yes, that will be better, because if I do the whole problem, maybe we will not come to know where you are going wrong. This is a very good question, question 17. This ODB book contains only very good exam questions only. All questions are past exam questions. So that's why it keeps repeating in the upcoming exams also. Got it? You do this question, then next class when you ask me a specific doubt, I will be more than happy to clear it up for you. All right? Hmm?
Yeah.
Okay, fantastic. So I think that part is also clear, friends. Any other doubts you are having? See, I'm here to work along with you so that we can win together. Okay, whatever support now, just like Achaleshwara rightly said, he wants a clarity on WACC. So we have found a solution. Like that, we'll find solution for each and every one of you. Our objective is coming attempt. You should all clear your examination. I'm there to support you. Not only me, a lot of faculties are taking a lot of effort. So just work along with us. Rest we will take care. Rajgopal, please tell me. You are unmuted, but we cannot hear anything. I think Rajgopal, you better type in the chat box. Something must be wrong with your mic. That must be the reason because you have unmuted. I can see that you have unmuted. I can see that you are speaking, but the audio is not reaching me. Just put a message in the chat box. Okay. Right. In the meantime, I'll just share with you, friends, one simple power of repetition. I know you all are studying hard. Just use a small technique when you're studying. Okay. One of my students, I always ask them when you do a question. For example, now when you're talking about question 17, for example, is what I told you in my ODB book, right? This question, when you do it without looking. Your answer might go wrong. After it goes wrong, then only check the answer. After that, you do the question again. Like that, without looking, when you do the same question 3 times. How many times? 3 times. That is when you get the concept and the application clear in your mind. Like that, ODB book, all questions, if you work out 3 times, you will easily score 30 out of 50 minimum in the problem solving part. Are you all clear with this part, friends? And if you want theory, I have arranged theory marathon at a very small price of, I think, 400 or 500 rupees. If you want that theory marathon, you can WhatsApp me. You have my WhatsApp number, right? I'll put it in the chat box. I will arrange it for you. Not only that, I have also made one more arrangement for all of you friends. 1 minute, 8893495263. The entire Inter FM recorded lectures, if you are weak on the concept, in 50 hours you can revise. That concept class was priced, not concept, it's concept and ODB book is fully solved. 50 hours means if you invest 5 days, you will finish off FM. Are you getting my point? So if you want those recorded lectures, earlier it was priced at 4,000. For the mentoring students alone, it is priced at 999, that is 1,000 rupees. So if you want it, just WhatsApp me. I will connect you with the helpline. Message them, they will arrange a coupon code for you and they will arrange the classes for all of you. All right. So I think with that, your theory, if theory is weak, we have theory marathon at just 500. If you want the entire lectures, it's available just for 1,000, but only this week. Okay. It is done exclusively to support the mentoring batch students. All right. Yes. So I think I'll wrap up my class with this, friends. Please type a yes or put a thumbs up in the chat box. Subin, capital budgeting പഠിക്കാനുള്ള ടെക്നിക്സ് പറഞ്ഞു തരാമെന്ന് പറഞ്ഞിരുന്നു. Okay, Subin, yes, I think one more thing. Subin had asked me earlier that, whether give me some techniques to study capital budgeting. I will just explain the technique for capital budgeting now. Give me a minute. After that, we'll wrap up my mentoring session. Okay. Subin, basically what happens is when you work out NPV, the formula for NPV is present value of inflow minus present value of outflow. So in order to solve this question will come for maybe 10 marks in the exam. Now the problem is people find this chapter very difficult. But let me tell you one simple technique with which out of the 10 marks, even though you don't study all the questions, you can minimum score 6 marks. Remaining 4 marks, let it go. Okay. These are the steps. First one is working note number 1, basic data. Working note number 2, analysis. Working note number 3, initial outlay. Working note number 4, in between cash flow. Working note number 5, terminal cash flow. Working note number 6, NPV. I'll tell you, using the 6 steps, if the question is coming for 10 mark, working note 1, basic data, you write all the numbers given in the question. So if they say investment is 1 lakh, write investment 1 lakh. Life 5 years, write life 5 years. Whatever number you see in the question, write it down. Now, when you write down this, will you get marks? No, you won't get marks. But when you write down everything, you will understand the question. And friends, normally in FM, people lose marks not because they don't know the answer. People lose marks because they don't know the question. So when you do this, you understand the question, automatically your solving becomes easy. Working note 2 is analysis. So for example, if they give you that cost of a machinery is 1 lakh, and they tell you that life is 5 years and salvage value is 0, automatically what does your brain tell you? Does your brain tell you that depreciation is turning out to be 20,000? All those points you find out, because every hidden information that you find out will help you to get at least 1 or 2 marks in the examination. So like that, you find out depreciation, you find out the WDV, all these are extra information that you find out using your effort. You get marks for all of them. After that, initial outlay, if you find out correctly, you get initial 1 to 2 marks. In between cash flow will again carry 1 to 2 marks. Terminal cash flow will again carry 1 to 2 marks, and NPV will carry 1 to 2 marks. So when you write down like this, when you find out the initial cash flow alone, you get 2 marks over there. In between it becomes correct. This is one pain area. People might go wrong over here. Are you getting? So you get 2 here, you get 2 over here, and you get 2 over here. Still, even if your answer goes wrong, you can easily score how many marks in the exam, friends? 6 marks. So if this also becomes all right, then it's a bonanza. You get 10 out of 10. But because it's a vast area, too many questions are there. Using this technique, when you go ahead, you will be able to score 5 to 6 marks easily. For the remaining 4 marks, you will have to spend maybe another 10 hours studying some 50 questions. Don't do that. Do only, basic questions that are available in your study material or the ones that is given in my mastery book. Are you clear now? Rajgopal, the questions what they are planning would be something like that, but I will not promise that when you do the exam, okay, that time it will be the same way. The test series will be covering everything. Are you clear with this part now? So friends, I think my time is almost up. 9:30 p.m. Nitika ma'am is coming live for the law revision, friends. So just like this, you'll have 9:30 to 10:30 law, 10:30 to 11:30 costing. So 3 topics you can revise in the next 3 hours. All best faculties are supporting you. Utilize this opportunity to the maximum. Okay. So I'm there with you. Let's study together. Let's win together. Thank you so much, everyone. Have a nice time ahead. Take care. Thanks a lot.